Over the past weeks, I've made many videos on some of my favorite REIT investment opportunities. I'm very bullish on REITs because they're currently priced at historically low valuations. In many cases, you get to buy REITs at large discounts to the net asset value. Just to give you one quick example, we've recently highlighted BSR REIT, which is a REIT that invests in Texan apartment communities, and it's currently priced at around $14 per share, but its net asset value per share is $22. So that's around a 35% discount. That's very attractive to me. But that doesn't mean that every REIT is today discounted. Quite the opposite. There are many of them that are still overpriced. And so to vary my content a bit, today I'm gonna highlight two REITs that I would sell if I own them today. Hey everyone, this is Yossi. I run an investment firm that specializes in REIT investing, and I just recently created this YouTube channel to discuss my latest thoughts on different REIT investments. If you're into this type of content, please consider subscribing and liking this video. Help me a ton. Thank you very much. And so the first REIT that I would consider selling today is called Gladstone Land. Its ticker symbol is LAND, L-A-N-D, and it's only one of two Farmland REITs. The other one is called Farmland Partners, ticker symbol FPI. Gladstone Land is typically the most popular of the two among individual investors because its dividend yield is a lot higher. It pays a dividend yield of around 3%, which is nearly the double of Farmland Partners, which is the other Farmland REIT. But what REIT investors tend to forget is that a higher dividend yield in itself doesn't say anything about the valuation of the company. A higher dividend yield may simply be the result of a higher payout ratio, more leverage, or investments in higher cap rate properties that have lower growth potential. And that's exactly the case here. Gladstone Land's latest net asset value per share is $16.56, but its current share price is around $19. So what this essentially means is that you're paying a roughly 20% premium to buy an interest in its portfolio of farmland. Its closest peer, Farmland Partners, FPI, on the other hand, is today priced at $12 per share, but we estimate that its net asset value per share is around $16. So it's the opposite here. Here you can buy an interest in its portfolio at a 20% discount to its fair value. So that's quite a large valuation spread. On one hand, you pay a 20% premium, and on the other, you pay a 20% discount. This would seem to imply that Farmland Partner is a lower quality REIT, but I think that's actually the opposite. Gladstone Land is externally managed, which leads to greater conflicts of interest. Then on top of that, it's also more heavily exposed to permanent crops, which typically have higher yields but also lower growth potential. And then finally, Farmland Partners also has an asset management and brokerage business, which allows it to grow faster because these are capital-light businesses. So all in all, I think that Gladstone Land is the lower quality REIT of the two, and despite that, it's priced at a much higher valuation. And so don't get lured by its higher dividend yield. I think that Farmland Partners is a much better opportunity today. It has a better aligned management team, it owns better assets, it has faster growth potential, and you get it at a large discount to its fair value. If anything, you may want to consider selling Gladstone Land to reinvest these proceeds into Farmland Partners. And then the second REIT that I would consider selling is called Public Storage. Its ticker symbol is PSA. If you look at its history, this has actually been one of the best performing REITs of all time. Self-storage REITs as a whole have actually been the best performing property sector with nearly 20% average annual returns and very little volatility. So why would you sell Public Storage? Well, I'm sure you've heard the saying that past performance is not indicative of future results, and I think that this is really the case here. Today, the self-storage space has become very competitive. Everybody has witnessed these very large returns, and so naturally it has attracted a lot of capital. Now there are plenty of other REITs competing for new development projects and self-storage acquisitions, and there are also a lot of private property developers who have also built properties in every busy intersection of the country. Today, there are about 10 square feet of self-storage space per capita in the US, which is more than 10 times what they have in the UK as an example. And so I fear that these REITs have now maxed out on their external growth potential. And this is happening right as people start to favor more experiences over things. There's also the sharing economy that could spell trouble to the self-storage sector, because now you don't necessarily need to buy yourself an RV anymore, or what else, a boat or whatever else that you can rent more easily these days. And then another thing that I worry about for the self-storage sector is that it greatly benefited from the pandemic, but these benefits may not be permanent. During the pandemic, a lot of people moved around as they changed jobs, a lot of people died, and so the older generation left stuff behind for the new generation, and a lot of stuff needs to get stored. Then people bought RVs and boats, which take a lot of space. People also try to make more room in their homes in order to have a home office. But now all these things are starting to reverse and return to normal, and so I fear that the demand for self-storage could suddenly start to decline, which could cause rental rates to drop and occupancy rates also to decline. But despite all of this, public storage is today still priced at a valuation that would imply that it will grow fairly consistently in the future, which I fear that might not be the case in the coming years, and this is why I would probably get out of it. I think that a better opportunity right now in the same space is a company called Big Yellow Group. Its ticker symbol is BYG, and it's the leader in the UK. The main reason why I'm much more bullish on this self-storage REIT is because I think that there are much more growth opportunities in Europe and in the UK specifically, where we currently only have 1 square foot of self-storage per capita compared to around 10 in the US. And this is right as the concept is getting more popular in the UK. Now people, as I mentioned earlier, are trying to make space for a home office in their homes. Homes are also quite a bit smaller in the UK. Cities are more dense. So there is a lot of demand now suddenly for self-storage, and Big Yellow has a lot of development opportunities. And the company also has a very strong track record, just like public storage. It has been investing in this space for over 20 years. It has generated around 16% average annual total returns, and that despite greatly suffering from the great financial crisis. If you adjust for that, its annual returns are actually closer to 20% per year on average. And I think it's still getting started. It has, I think, at least another decade or two of rapid growth ahead of it. And despite that, its valuation is not so much different from that of public storage. So again, here I think that you have an opportunity to potentially sell public storage and reinvest in its peer Big Yellow. I think that over time it will deliver higher returns with lower risk. And that's why I probably wouldn't buy public storage at current price. And so to conclude here, I think that a lot of REITs today are very attractively priced, but not all of them are. And public storage and Gladstone land are 2 good examples of that. You have to be very selective, even in today's market. You cannot just invest in any REIT. Thank you very much for watching till the end. If you want to learn more about other REITs that I wouldn't buy today, make sure to like and subscribe. I'm posting weekly videos on REIT investing. And also, if you want to learn more in real time about my latest REIT investments, please feel free to follow me on Twitter. I'll put a link in the description. See you at my next video.